Welcome to OnlyPounds. This is part 2 of our series on investing. In the first part, we gave you a brief overview of how stocks and the stock market work, and in this video, we're going to go through the most hands-off and possibly the best way for most people to invest, and that's through index funds. When you hear the news announcing market reaching 52-week lows, or more recently, market reaching all-time highs, they are generally referring to the prices of indexes, such as the S&P 500, the Nasdaq, Dow Jones, and the FTSE 100. You can think of an index as a collection of stocks, as a way to gauge the performance of the market in either a region or an industry sector. So imagine you invest £1,000 into the S&P 500. Your money would be used to buy the stock of every single one of these 500 companies. These aren't split equally as £2 per company. The bigger companies would receive a higher proportion, so you'd expect companies like Apple to receive more of your £1,000 investment than companies such as eBay. This gives you good stock diversification, which basically means your money is spread out between many stocks, which tends to protect you from the higher risk of investing in individual stocks, while still seeing a decent return on your money. It also reduces volatility, which is good for a lot of retail investors, as individual stocks can see 20% swings day by day, which can be a lot to stomach. Some of you may be thinking, why not invest in individual stocks, or in a hedge fund? Won't that make me richer quicker? Well, yes, but actually no. Studies have shown that the S&P outperformed hedge funds over 90% of the time. These are professional investors who do it full time, so it wouldn't make much sense for individual investors to buy individual stocks in an effort to beat the market. Another reason is because index funds have very low fees, which make it favourable over hedge funds, which tend to have higher fees, as they have to employ stock pickers who try to beat the market average, with no guarantee of actually doing so. So even if the fund manages to beat the market, with fees normally over 2%, you tend to feel those extra gains start to disappear, which is not worth the added risk. So, the big question: what returns can you expect to get? Well, it's up some years and down others, but on average, if you're in it for the long run, you can expect to grow your money by about 8% a year when you reinvest dividends and adjust for inflation, which has historically been around 2% a year. This doesn't seem like that much, right? Well, let's take a look at an example. Okay, so imagine you're 18 years old. You have no money saved, but you've managed to find an apprenticeship which pays £16,000 salary a year, or just over £14,500 after you pay your tax and national insurance. That's £1,200 a month you see in your bank account. If you start saving, but not investing, a quarter of that, so £300, every month until you retire, you'll have saved just over £176,000 over those 49 years of working and saving. Now, £176,000 is a lot of money. In today's terms, you'd be Lambo rich. However, due to inflation, your money is worth less over time. Assuming an inflation rate of 2%, £176,000 in 2069 is the same as having around £68,000 of buying power today. Saving all of your money as cash for the long term sounds like a good idea, but unless you can use that money to at least match inflation, you'll be coming out the other side losing. To put it in context, even £1 in the year 2000 has the equivalent value of around £1.50 today. So, 49 years of saving £300 a month, and you see a lump sum of £176,000. What if you'd invested that at an 8% return? Well, the numbers turn out a little bit higher. Investing £3 a month into the S&P 500, assuming an average rate of 8%, which is already taking inflation into account, you'd end up with a slightly nicer sum of around £2 million. Yes, that's right, £2 million, just from putting aside £300 a month. And remember, this is adjusted for inflation, as since inception, the S&P has a historic annualized return of around 9.8%, whereas the UK government is now aiming for around 2% inflation per year. With a 9.8% return, you can expect your account balance to be around the £4 million mark. Now, it's worth noting that past performance is not a guarantee of future performance. However, if you're looking for a way to put your money to work without doing much work yourself, investing in an index fund is arguably the best way to do so. Also, investing has risks. You're not guaranteed to make money, and there's a chance you could lose money. But by buying regularly and holding on to investments for the long run, your chances of being profitable increase. To check out your own examples, a great tool is the Dave Ramsey Investment Calculator. We've dropped the link in the description. The values on that page are in dollars, but you can read them as pounds, so there's no need to try and convert the currency. Putting in £300 a month is a technique called pound cost averaging, which basically means that you consistently invest when markets are high and when markets are low. This is a tried and tested method to create long-term wealth, and if you start young, it almost guarantees that you'll become a millionaire in life. What happens if you start just a little bit later? Well, let's imagine you wait 10 years and start at age 28 as opposed to 18. Keeping everything the same, so an 8% return on £300 a month, you'll see your money grow to around £960,000 as opposed to £2 million. This is because investing is like making a snowman. You start with a little bit of snow, but when you keep adding to the snow and rolling the snow, it grows exponentially. The same thing happens with your money. The longer you give it to grow, the more you'll make. As you get older, you should have less of your portfolio in stocks and move over to safer equities such as bonds, which offer less return but are generally much safer, especially as when you're in retirement you'll likely need to use your money. Imagine you have all your money in equities, which is just another term for stocks, when you turn 67. But then there's a recession and your £1 million stock portfolio drops 50% to £500,000. That's still a lot of money, however it's much safer risk management to gradually move your stocks over to bonds. There are bond index funds available, so it's just as easy to invest in these as it is to invest in stocks. How much should you move over? Well, as with all of this, it's up to you. A general rule of thumb is that you have 100 minus your age invested in stocks. So if you're 25, 75% of your portfolio should be in stock and the rest in bonds. However, this depends on your risk tolerance, as many younger people are more inclined to be 100% in stocks, with cash on the sidelines until they feel ready to delegate some to bonds. You should always have some cash in case of emergencies. Check out our video on budgeting to find out how much. Now, some of you may be able to invest more than £300 a month, some of you less. So to figure out your target retirement number, you can follow the multiply by 25 rule and the 4% rule for retirement. We'll keep this brief, but essentially when you reach retirement, you should be able to withdraw 4% of your portfolio, that's both your stocks and bonds, without running out of money. Look out for our other part on investing, where we explore budgeting for retirement further, using these rules. If you're looking to get started, a great platform is vanguardinvestor.co.uk, as they have a great selection of funds and some of the lowest expense ratios, which is just another word for fees, out there. If you choose to sign up with Vanguard, the S&P 500 ticker symbol is VUSA, or VUSA, but there are other indexes such as the Nasdaq and the FTSE indexes that you can invest in. You can also invest in many Vanguard funds through fee-free platforms such as Trading 212. OnlyPounds has no affiliation with Vanguard or any of the companies mentioned. If you do have any questions, feel free to tweet us at OnlyPounds and we will do our best to answer. Thank you for watching. Please like, subscribe and leave a comment sharing how you feel about investing in stocks and whether you'd like us to explore investing further. And remember, here at OnlyPounds our mission is to expose our young people to financial education. We are not your financial advisors, and it is up to you to continue researching the best options for you. We do our best to provide information you can look into and build upon, using your best judgment. Catch you guys soon.